October 1929. Investors watched stock prices fall day after day, week after week. Many believed it was just a correction. The economy was strong, they said. America was different. The fundamentals were sound. Until they weren't. Within 3 years, unemployment hit 25%. Banks failed by the thousands. The global economy collapsed. September 2008. Lehman Brothers filed for bankruptcy. Within days, the entire global financial system seized up. Credit markets froze. Major banks and insurance companies faced extinction. Governments around the world launched the largest coordinated bailout in history to prevent a second Great Depression. For a moment, the world stood at the edge of complete financial collapse. January 2026. The United States carries $38 trillion in national debt. Interest payments exceed the defense budget. Annual deficits run between $1.5 and $2 trillion. Household debt is at record levels. Corporate debt has exploded. The economy depends entirely on the assumption that borrowing can continue indefinitely, and almost everyone believes this time is different. This is the money timeline. Today, we're going to examine 3 moments in American economic history: the Great Depression of 1929, the financial crisis of 2008, and the debt trap of 2026. We'll look at what they have in common, how they differ, and why the patterns that destroyed economies twice before are back again. Stronger, more complex, and possibly more dangerous. Let's start with where we are today, because understanding the present is essential to seeing the patterns from the past. The United States is operating in a fundamentally unstable financial environment. Public debt stands at $38 trillion, roughly 120% of GDP. The federal government has run deficits for decades, and there's no plan to stop. Annual deficits of $1.5 to $2 trillion are now considered normal. Interest payments on this debt are approaching $1 trillion per year and rising fast as older low-interest bonds mature and get replaced with higher-rate debt. But it's not just the government. Household debt is also at historic highs. Americans owe roughly $17 trillion in mortgages, auto loans, student loans, and credit card debt. Corporate debt has exploded to over $10 trillion, much of it taken on during years of near-zero interest rates. Companies borrowed cheap money to buy back stock, pay dividends, and finance acquisitions. Now those debts have to be serviced at much higher rates. After more than a decade of historically low interest rates, the Federal Reserve was forced to raise rates aggressively in 2022 and 2023 to combat inflation. Rates went from near zero to over 5% in less than 2 years. This rapid increase in borrowing costs has stressed every part of the economy. Mortgages became unaffordable. Credit card interest rates soared. Business expansion slowed. The economy is adjusting, but the adjustment is painful and incomplete. Inflation, which reached levels not seen since the 1980s, has eroded purchasing power for most Americans. Wages have risen, but not as fast as prices for food, energy, and housing. The middle class is squeezed. Savings rates have fallen. Consumer confidence is shaky. At the same time, the global environment has become more unstable. Geopolitical conflicts are increasing. The war in Ukraine, rising tensions between the US and China, trade relationships that seemed stable for decades are fracturing. Supply chains that were optimized for efficiency are now being reconfigured for security. Globalization is reversing. Countries are prioritizing self-reliance over cooperation, which increases costs and reduces growth. The financial system is still functioning, but it's fragile. It depends entirely on confidence. Confidence that governments will keep paying their debts. Confidence that central banks will prevent crises. Confidence that the economy will keep growing. This confidence has held so far, but confidence is not a fact. It's a feeling, and feelings can change very quickly. To understand where we might be heading, we need to look at where we've been. The Great Depression remains the worst economic disaster in modern history. In the 1920s, the United States experienced a period of unprecedented economic growth. The stock market soared. New technologies like automobiles, radio, and electrification transformed daily life. Credit became widely available for the first time. People could buy homes, cars, and consumer goods on installment plans. The idea of borrowing to finance a better lifestyle became normalized. The economy appeared strong, but underneath there were deep structural problems. Wealth inequality was extreme. The richest 1% controlled nearly 40% of the nation's wealth. Most Americans had very little savings and lived paycheck to paycheck. Agricultural prices were collapsing, devastating rural areas, but in the cities, stock speculation was rampant. People borrowed money to buy stocks, a practice called buying on margin. You could put down 10% and borrow the rest. As long as stock prices kept rising, this worked beautifully. And because stock prices kept rising, more people borrowed more money to buy more stocks. It became a self-reinforcing cycle. Leverage piled on leverage. The banking system was fragmented and poorly regulated. There was no deposit insurance. If your bank failed, you lost everything. Banks themselves were heavily invested in the stock market and in real estate. When asset prices started falling, banks faced insolvency. The crash began in October 1929. Stock prices fell sharply, triggering margin calls. Investors who had borrowed money to buy stocks were forced to sell to cover their debts. This selling caused prices to fall further, which triggered more margin calls, which caused more selling. The cycle fed on itself. Within weeks, fortunes evaporated, but the real disaster came in the years that followed. As stock prices collapsed, banks that had lent money against those stocks faced massive losses. Depositors, fearing bank failures, rushed to withdraw their money. This caused bank runs, which caused more banks to fail. Between 1929 and 1933, roughly 9,000 banks collapsed. Millions of Americans lost their savings. As banks failed, credit disappeared. Businesses couldn't borrow to meet payroll or buy inventory. Factories closed. Unemployment exploded. At the peak in 1933, 25% of the workforce was unemployed. Those who had jobs saw their wages cut dramatically. Consumer spending collapsed, which caused more businesses to fail, which caused more unemployment. The government's response made things worse. Believing in balanced budgets and the gold standard, policymakers refused to use deficit spending to stimulate the economy. Instead, they raised taxes and cut spending, deepening the downturn. The Federal Reserve failed to act as a lender of last resort, allowing banks to fail rather than providing emergency liquidity. Trade policy became protectionist with the infamous Smoot-Hawley tariff, raising import duties and triggering retaliation from other countries, which collapsed global trade. The lesson of the Great Depression is clear. An economy built on excessive leverage, weak regulation, and speculative bubbles is vulnerable to sudden collapse. When confidence breaks, credit disappears. When credit disappears, the economy seizes. And when policymakers respond with austerity rather than stimulus, a downturn becomes a depression. The financial crisis of 2008 followed a different path, but shared the same underlying cause. Too much debt, too much leverage, and too much confidence that the system was safe. In the years leading up to 2008, the U.S. experienced a massive housing boom. Home prices rose year after year. Home ownership became not just a place to live, but an investment strategy. People bought houses they couldn't afford, assuming prices would keep rising and they could refinance or sell at a profit. The financial industry enabled this with a flood of easy credit. Mortgage standards collapsed. Subprime mortgages were offered to borrowers with poor credit, low income, and no down payment. These risky mortgages were then bundled into complex financial instruments called mortgage-backed securities and sold to investors around the world. Credit rating agencies, paid by the banks creating these products, gave them top ratings. Everyone believed the risk had been eliminated through financial engineering. Banks didn't just lend money, they borrowed heavily themselves to amplify returns, a practice called leveraging. Investment banks operated with leverage ratios of 30 to 1 or higher. This meant a small decline in asset values could wipe out their capital entirely. But as long as housing prices kept rising, this seemed safe. The system was also deeply interconnected. Banks in the U.S. sold mortgage-backed securities to banks in Europe and Asia. Insurance companies like AIG sold credit default swaps, essentially insurance policies on these securities without holding enough capital to pay claims if things went wrong. When one institution faced trouble, the stress spread instantly across the global financial system. The crisis began when housing prices stopped rising. Borrowers who couldn't afford their mortgages started defaulting. As defaults rose, the value of mortgage-backed securities collapsed. Banks holding these securities faced massive losses. Trust between banks evaporated. If you didn't know which banks were holding toxic assets, you didn't lend to any of them. The credit markets froze. In September 2008, Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy. Within days, panic spread globally. The commercial paper market, which funds day-to-day business operations, seized up. Money market funds, considered ultra-safe, faced runs. Major corporations couldn't make payroll. The global economy was hours away from a complete meltdown. Governments responded with overwhelming force. The Federal Reserve slashed interest rates to zero and began buying trillions in bonds and mortgage-backed securities. The U.S. Treasury bailed out major banks, AIG, and the auto industry. Deposit insurance was expanded. Governments around the world launched coordinated stimulus programs. These actions prevented a second Great Depression, but they came at a cost. Trillions in private debt were transferred onto public balance sheets. Governments and central banks absorbed the losses that should have fallen on banks and investors. This stabilized the system, but it created long-term distortions. Banks knew they would be bailed out if they failed, which encouraged continued risk-taking. Inequality widened as asset prices recovered faster than wages, and public debt exploded, setting the stage for the fiscal crisis we face today. The lesson of 2008 is that systemic risk can be hidden in complexity. Financial innovations that appear to spread risk can actually concentrate it. Global interconnectedness means a crisis in one country spreads instantly to others. And while aggressive government intervention can prevent collapse, it creates moral hazard and transfers costs to future generations. When you examine the Great Depression, the 2008 crisis, and the current situation, a clear pattern emerges. The details differ, but the structure is the same. Each period was preceded by rising debt and leverage. In the 1920s, it was stock market speculation on borrowed money. In the 2000s, it was housing speculation on borrowed money. Today, it's government, household, and corporate debt all rising simultaneously. The common thread is the belief that borrowing is safe because the future will be better than the present. Each period was characterized by widespread confidence that risks were under control. In the 1920s, people believed the stock market had entered a permanent plateau of prosperity. In the 2000s, financial engineers believed they had eliminated risk through securitization and diversification. Today, policymakers believe that as long as the U.S. dollar remains the global reserve currency, debt doesn't matter. Each period saw the rise of new financial instruments or practices that seemed innovative but concealed systemic risks. In the 1920s, buying on margin allowed ordinary people to speculate in markets they didn't understand. In the 2000s, mortgage-backed securities and credit default swaps spread risk globally, but made it impossible to assess who was exposed. Today, the sheer scale and complexity of government debt obligations, combined with underfunded entitlement programs, creates risks that are difficult to measure and impossible to manage through normal policy tools. Each period experienced a triggering event that shattered confidence. In 1929, it was the stock market crash. In 2008, it was the collapse of Lehman Brothers. The trigger for the next crisis could be anything: a sovereign debt default, a major bank failure, a geopolitical shock, a sudden loss of confidence in U.S. treasuries. The specifics don't matter. What matters is that when confidence breaks, the system's vulnerabilities are exposed. And in each case, the economy was more fragile than it appeared. The 1920s boom masked agricultural depression and inequality. The 2000s boom masked a housing bubble built on fraud. Today's apparent stability masks unsustainable fiscal deficits, political dysfunction, and a global order that is fracturing. If history were simply repeating, we could apply the lessons from 1929 and 2008 to avoid the next crisis. But while the patterns are similar, today's situation is more dangerous in several ways. First, public debt is already at extreme levels. In 1929, U.S. government debt was around 16% of GDP. In 2008, it was around 65%. Today, it's 120% and rising. This matters because debt constrains policy options. In 2008, the government could borrow trillions to bail out the financial system because its balance sheet was relatively clean. Today, the government is already deeply in debt. If another crisis requires massive intervention, where does the money come from? More borrowing pushes the debt to GDP ratio even higher, which increases the risk of a sovereign debt crisis. Second, monetary policy has less flexibility. In 2008, the Federal Reserve cut interest rates from 5% to 0 and launched quantitative easing. This provided enormous stimulus. Today, if a crisis hits, interest rates are already historically low in real terms. The Fed has less room to cut, and quantitative easing has already been used extensively. Markets may not respond as strongly to tools that have been overused. Third, political divisions make coordinated responses more difficult. In 2008, despite deep partisan disagreements, Congress ultimately passed TARP, and the stimulus packages needed to stabilize the economy. Today, political polarization is far worse. Congress struggles to pass basic budget bills. The idea of quickly mobilizing trillions for a bailout seems almost impossible. Divided government creates policy paralysis, and paralysis during a crisis turns a downturn into a catastrophe. Fourth, the global environment is more unstable. The 1920s collapse was largely contained within Western economies. The 2008 crisis occurred during a period of relative geopolitical calm. Today, we face great power competition between the US and China, war in Europe, instability in the Middle East, and a breakdown in global trade cooperation. A financial crisis in this environment could easily escalate into broader conflict or trigger a complete unraveling of the global economic system. Fifth, the margin for error is smaller. In past crises, the U.S. benefited from being seen as a safe haven. Investors fleeing risk bought U.S. treasuries, which lowered borrowing costs and provided liquidity. But if the next crisis is triggered by concerns about U.S. debt sustainability, that safe haven status disappears. If investors flee U.S. treasuries instead of buying them, interest rates spike, which makes the debt problem worse, which causes more investors to flee. It becomes a self-reinforcing spiral. The tools that prevented past crises from becoming depressions are now constrained. The fiscal space is limited. The monetary space is limited. The political will is uncertain. And the global cooperation that stabilized the system in 2008 no longer exists. History doesn't repeat in the same form, but it does rhyme. If another financial crisis is approaching, there will be warning signs. Some are already visible. Rising debt service costs are a clear signal. As interest payments consume a larger share of the federal budget, the government has less flexibility to respond to shocks. When interest costs exceed spending on defense or key social programs, it indicates the debt burden is becoming unsustainable. Credit market stress is another indicator. Watch for widening spreads between government bonds and corporate bonds. Watch for banks tightening lending standards. Watch for rising default rates on consumer debt, especially auto loans and credit cards. These are early signs that households and businesses are struggling to service their debts. Political dysfunction around debt ceiling negotiations or budget crises can also signal trouble. If markets begin to doubt that the U.S. will meet its obligations, even temporarily, it could trigger a loss of confidence. The U.S. came close to default in 2011 and 2023 during debt ceiling standoffs. Each time, markets grew nervous. A future standoff that actually results in a missed payment, even if quickly resolved, could have severe consequences. International stress is another warning. Watch for signs that foreign holders of U.S. debt, particularly China and Japan, are reducing their positions. Watch for moves by other countries to diversify away from the dollar in trade and reserves. Watch for instability in emerging markets, which often serves as a leading indicator of broader financial stress. Finally, watch for complacency. One of the clearest warning signs before both 1929 and 2008 was the widespread belief that the system was safe and that past crises couldn't happen again. When economists, policymakers, and investors are uniformly confident, it often means risks are being ignored. If the current system breaks, The consequences will be severe. The exact form is unpredictable, but the general outline is clear. A crisis would likely begin with a loss of confidence. Perhaps investors suddenly question the U.S. government's ability to service its debt. Perhaps a major financial institution fails and triggers panic. Perhaps a geopolitical shock disrupts global markets. The trigger could be anything, but the result would be the same. Credit markets freeze, lending stops, asset prices collapse. In a modern economy, credit is oxygen. When it disappears, everything suffocates. Businesses can't make payroll. Consumers can't access credit to make purchases. The stock market crashes. Retirement accounts lose value. Unemployment spikes. The government and Federal Reserve would attempt to intervene, as they did in 2008. But this time, the interventions would be constrained. The government's high debt levels would limit fiscal stimulus. Rising interest rates would make borrowing more expensive. Political divisions would delay or block necessary legislation. The Federal Reserve's already expanded balance sheet would limit its ability to buy assets. If the crisis is severe enough, it could force the government into impossible choices. Continue borrowing at unsustainable levels and risk a sovereign debt crisis. Or cut spending dramatically and risk deepening the recession. There are no good options, only choices between bad and worse. The global consequences would be even more severe than in 2008. If the US dollar loses its status as the global reserve currency, international trade collapses. Supply chains break. Countries that depend on dollar-denominated debt face defaults. The global financial system, which has operated under dollar dominance for 80 years, would have to be rebuilt from scratch. Domestically, the social and political consequences would be profound. High unemployment, collapsing asset values, and government austerity would fuel unrest. Trust in institutions, already low, would collapse further. Political extremism would rise. The risk of authoritarian responses or social breakdown would increase. The breaking point might not be a single dramatic event. It could be a slow unraveling, a series of crises that gradually erode stability until the system can no longer function. But whether sudden or gradual, the result would be a fundamental restructuring of the American economy and global financial system. The Great Depression taught us that excessive leverage, weak regulation, and policy mistakes can turn a downturn into a catastrophe. The 2008 crisis taught us that complexity and interconnectedness can hide systemic risk until it's too late. The current situation combines the worst elements of both: high debt, policy constraints, political dysfunction, and global instability create conditions that history has shown are extremely dangerous. History is not repeating in the exact same form, but it is repeating in structure. The same forces of leverage, complacency, and inevitable shock are present. Whether a new financial crisis occurs depends on how these pressures are managed. The risk is elevated not because collapse is inevitable, but because the margin for error has disappeared. The United States has escaped collapse twice before. In 1929, the failure to act quickly turned a recession into a depression. In 2008, aggressive action prevented depression but created new vulnerabilities. The next time, the tools that save the system may not be available, and the confidence that has held the system together may finally break. Thanks for watching The Money Timeline.